It's for informational, educational purposes only, no advice of any kind, no solicitation of any kind. If you're interested in any of our funds or syndications, request PPM, private placement memorandum to create investors only. Consult with your attorney or CPA professional before making any investment decisions. So without further ado, let's move forward to the presentation.
Today's
Let me
topic.
introduce, oh, go ahead, I'm sorry.
I'm sorry, go ahead, Mike.
Yeah, I just want to take this opportunity and introduce Andrew Zwerman and Tom Rund, CPAs with Citrin Cooperman. We work closely with them on tax work for many of our funds and syndications. We appreciate them coming on the Lunch and Learn. Once again, Andrew and Tom, welcome. Thank you for coming on this Lunch and Learn. Go ahead, Diana.
Just wanted to let you know, if you have questions, go ahead, put them in the chat. If you want to talk, just type in the chat, you want to say the question, and I can allow you to talk. Andrew, Tom, thanks for coming on again. Let me know, do you prefer them to type in or do you want them to be able to talk?
Well, first off, good afternoon, everybody. I am Andrew Zwerman, and as it relates to questions, maybe we could do a chat first. And what we were going to think about doing was Tom will read the questions, stop me as we go, and then we will answer the questions as we go. So chatting would definitely be preferred. And at the end, we'll open up the forum for a total conversation at that point in time.
Great. Sounds good. I'll let you take it from here.
Okay. Well, good afternoon, everybody. As Mike and Deanna said, I'm Andrew Zwerman. I am a CPA. I have a master's degree in taxation. Have been in public accounting for close to 38 years now. I have a specialty and a niche in the real estate industry. Have been advising on different real estate transactions and how to structure real estate deals. Have been doing plenty of webinars, seminars, classes on this subject matter. We're from Citrin Cooperman. And also with me is Tom Rund, a CPA and a great accountant. And I'll let Tom speak for a couple of minutes about himself.
You need to unmute.
Sorry, I thought I was waiting for Deanna to unmute me. That's fine. Good afternoon, everyone. My name is Tom Rund. As Mike said, we've been working together for a few years now on his funds. I'm a CPA here at Citrin Cooperman. I've been in public accounting for about 15 to 16 years now. Before that, I was in the private industry working for a Fortune 500 company. Most of my clients are in the real estate professional services areas. In that capacity, I provide tax planning, tax compliance services, as well as consulting on various matters like business succession, wealth preservation, retirement planning.
Thank you, Tom.
Thank you.
Okay. So today we're going to talk about how to minimize taxes on the sale of your business. And what we focus on, what I focus on for many years, is helping clients pay less taxes, make more money, and have what we call a better financial quality of life. And as accountants, we could really help clients achieve those goals. And as accountants, we listen to our clients and what goals they want to achieve, because that's what we're really there for. We just don't push paper. We just don't prepare tax returns. We listen to clients. And in this case, we're going to talk about how we could help you if you're potentially selling your business. If you have a business, maybe you're a doctor or a dentist, or some type of professional or manufacturer of widgets, whatever it is, you're going to one day, as you get older, want to retire and sell your business. There's two components to selling your business. It's the operating part of the business, and then there's the real estate side. If you own the real estate, that's completely separate and distinct, or should be. And we're just going to talk about how to sell them separately and take advantage of the tax rules that are available. So it might be just number one, it might be just number two, or it might be number three, which is a combination of number one and two. So if we go to the next slide. So when you sell a business, or if you have any type of transaction that's going to create taxable income, the basic components of tax planning comes down to really three things: deferring the tax, eliminating the tax, or converting the tax. And conversion is not like religion. It's converting from ordinary income to capital gains. And that is the third thing, is the most important thing you want to do. And deferring is probably second. And the first one, eliminating, is the hardest and most challenging. So when you sell your business, what drives the taxation of the sale is how you characterize the assets within the sale. Okay. And different classes or different types of assets being sold dictates and determines the taxation, if it's going to be taxed immediately or can be deferred, if it's going to be taxed at ordinary rates as high as 37% federal plus state, or it would be taxed at capital gain rates, which is 20%, all right, at the federal level. So that's 17 percentage points difference. Right now, we still have capital gain rates at 20%. And if you're selling your business, you're probably going to want to take advantage of deferring as much as possible and bringing your tax burden, your tax rate down from 37 to 20%. So you do that by allocating assets to certain asset classes that will generate capital gains. The biggest thing in a professional practice or any business is goodwill. If you say you sell a business for $1 million, we want to allocate as much of that $1 million to goodwill as possible, because that will be taxed at 20% rather than 37%. We're going to want to stay away or minimize the allocations to other assets that would generate ordinary income. So if you allocate part of the purchase price or sale price to equipment, that may generate depreciation recapture, which is taxed at ordinary rates immediately. If your business has some inventory, if you're a doctor or a dentist and you have crowns and caps and things like that, that inventory should be at a minimum, because the sale of inventory is ordinary at a higher rate. A covenant not to compete is ordinary at a higher rate. So when you're selling your business, it makes sense to sell as much as possible the goodwill portion of the business, and that comes down to the asset allocation. If, like B says, if you take a note, a promissory note, and you say for that $1 million, you say, give me 300,000 up front, and I will take a note for $700,000. The $300,000 up front would be taxed now, but the $700,000 would be deferred and would be taxed as you receive the principal payments on the note. The amount would be deferred. All principal payments would be capital gains. Any interest income paid with the payments would be ordinary. But you can defer the taxation of the sale of your business over the life of the promissory note. So depending on your circumstances, that could be very good also. Tom, any questions in the chat box? Anything you want to add here?
No open questions now, but how about if I'm going to sell my business, how do I put a value on it? Are you able to help with that?
Sure. So we can help in two aspects. The first aspect is helping you value the business, and our firm and Tom and myself could help a client value the business. And we have a separate department, like a merger and M&A department that helps value businesses. We have business valuation department that can help with that. But obviously, your value of your business is based on cash flow and earnings. And there's a cap rate that can be used, and it's beyond the scope of this presentation, but we could definitely help with adding value and building up the value of the business so you could get more money for your business. And then the asset allocation, we really get involved with your attorney, and we want to see a draft of the sale of the business, and we want to get involved with the asset allocation in the contract, as letter A says. If get the asset allocation in the contract, and if a willing buyer and seller signs the contract, the IRS cannot challenge that allocation. If the contract does not have an allocation in it, then on audit, you could be scrutinized and challenged on the allocation. And if you happen to put a lot of assets to goodwill, the IRS are going to be motivated to say, no, that was equipment or something else, because they're going to want ordinary rates. So we could help with valuing the business and help working with your attorney to make sure that asset allocation is in the contract. Great question, Tom.
So Andrew, if I'm getting ready to sell my business, is there anything I can do to prepare? Maybe clean up my books, review my account balances on my balance sheet? What do you suggest there? Maybe rein in some of my personal expenses that may be going through, things of that nature to make it more presentable to a buyer to get a true picture.
Yeah, excellent questions. So first thing is you need a qualified accountant, and Tom and I happen to know a few that can help you. You really need to plan for it in advance. I would say if you're thinking about selling, retiring, a combination of that, you should start about 3 years in advance before the potential transaction. As Tom kind of questioned and alluded to, you should start cleaning up your books. Stop putting through crazy auto expenses, travel. Try to get the books really accurate. So a quality of earnings report or some type of report can be done that will show the highest value. And then a potential buyer, when they do their due diligence, will be able to zoom in on your value and get to it pretty easily. So I would say 2 to 3 years at minimum, you should be talking with your accountant, preparing valuations, getting your books cleaned up, organized, and presentable. Great point, Tom. All right, so let's go to the next slide. Real estate. This goes to my heart. I absolutely love taxation of real estate. Been talking about it for a long time. Maybe some other people don't get as excited with taxes and real estate like I do, but this is an area that you can defer taxes, which we'll talk about, and really be taxed at a lower rates when you sell. So let's first talk about a potential real estate sale. If it's your office building, your medical building, it's your multifamily residential rental property, 4-family brownstone in Brooklyn. When you go to sell, you could do what's called a 1031 like-kind exchange. I like putting in the like-kind in there because people just focus on the 1031. It's important that you focus on like-kind, not really the code section. When you sell rental real estate and you want to take advantage of this tax rule to defer paying the tax on your sale, you could do a like-kind exchange. Exchange rental property for rental property, not rental property for a residence, second residence, first residence. It could be residential for commercial. It could be a rental parking lot for a multifamily building, but it has to be rental for rental. Okay, so number one, you have to buy property equal or of greater value to defer. So if you're selling a piece of property for $5 million, you must reinvest that $5 million in another property. Even if you have a mortgage, it goes by the gross amount. So if your mortgage was $1 million and you only net 4 million, you have to reinvest $5 million, okay, in the new property or properties. You have 45 days to find the property and document that you found it or properties. You have 6 months to close. The money from the sale you cannot touch. It must go into a qualified real estate exchange agent escrow account. They hold on to it, and then you could buy property or properties, up to 3 properties, as number 4 says. There's many different ways of doing this. You could buy a property, a new property, and own it straight, or you could go into what's known as a tenants in common, a TIC, and you could be partners with many people as long as you're exchanging for a tenant in common ownership, not a LLC membership interest. That doesn't qualify. We get that question a lot. Again, I don't know if there's any questions in the chat box. Tom,
No.
what things do you normally see? What do you see clients questioning? What can
Well, I
we
think
bring
what
up
you
to them?
said earlier, with the tick and, if a lot of the properties are held in an LLC, there are certain steps that need to be done. If you're doing a 1031, the drop and swap, because you can't exchange an LLC interest, even though it owns real estate for, a property. So that's technical, it might be beyond the scope. But
Yeah,
I think,
but I guess I think it's worth saying, and what Tom means by a drop and swap is if Tom and I own a piece of real estate in an LLC, and we want to sell it, but I want my money and Tom wants to exchange and defer it, we can't sell the asset out of the LLC. We have to first drop the asset out of the LLC into a tenants in common relationship. And then my tenants in common relationship, I would sell and cash out. Tom would take his tenant in common ownership and exchange it for other real estate, and therefore would have the ability to defer and do a 1031 like kind exchange. That's what you meant, Tom, by a drop and swap, correct?
correct.
Okay, great.
And I think it, with these 1031 tax deferred opportunities, depending on how long it is held, it could potentially eliminate tax, correct me if I'm wrong, maybe you can explain, at death, at the time of your death, there's potential for a complete step up.
Yes.
So you're
Great
preserving the
point.
wealth of your family, and there's the taxes never paid on this
Excellent,
sale.
excellent point. So what many real estate families have done is they hold on to the property upon, rather than selling, they hold on to it, and they die with the property in their name. When you die, the value of the property gets stepped up to fair market value, not subject to income tax. And then the next generation gets to depreciate the property again.
Yep.
Okay. And if they sell, they will have a higher cost basis and there'll be less of a gain. So that is not really an exchange, which we're talking about, but it is another way of keeping wealth within the family. A lot of families that own real estate for 4 or 5 generations in Manhattan, for example, Helmsleys and things like that, they don't sell. They die with their real estate and give it to their kids and give it to their kids and give it to their kids, because every time somebody passes away, the value gets stepped up to fair market value for taxes, and no taxes get to be paid, will not be paid, and they get to depreciate again the same building over and over again.
Right.
So Tom, that's a great point also.
And even
Another
then,
good
when you
benefit
take
of
the
real estate.
step up, you can get a cost segregation report done to get accelerated depreciation. So
That's
it's not,
right.
Over 27.5 or 39 years, you could chop it up into different asset classes maybe
Yes.
take 30 or 40% of the property out of building and put it into a 5 or 7 year asset and take a
Yes.
tremendous depreciation deduction.
Yes, and that's another technique on purchasing real estate or receiving it via bequest. I always use the example, if you have 30 apartments in an apartment building, and that means you have 30 refrigerators, 30 stoves, 30 ovens, 30 microwaves. All of that is equipment, and that equipment is eligible for bonus or 179 depreciation that could be immediately deducted. So if you do a cost segregation on like a $1 million building, you could probably get $300,000-400,000 of write-offs right away on depreciation. So yes,
Mhm.
that's a great point also, which we'll talk a little bit about, dis distributions on real estate and how that's taxed or deferred also in a couple of minutes. So that's real estate, like kind exchanges. If we go to the next slide.
Andrew, I think
Well-
we have a question here, and I think I
Excellent.
understand it. It says, what happens if you pass the $12.6 million per person times 2 exclusion with step up basis? So I think the question is, does that when I take the step up in my estate, does that
Yeah,
eat into my
that
exclusion? I
so
believe
that
might
is
be.
that is an estate tax matter.
Yep.
And when you die, you have to pay estate tax if you're over the thresholds. The
Correct.
thresholds keep on changing. They're going to go drastically down in 26 if they're not extended. But what you need to do there, it's hard to answer that question. Your accountant, again, you need a competent, qualified accountant, would do an analysis to see if the step up is worth more, because you'll save income taxes, versus the estate tax that may have to be paid on death, depending on your net worth threshold. If your net worth is less than the threshold, you're always going to benefit by the step up and not paying the income tax. If your estate is over the threshold, then you do have to contemplate estate tax versus the income tax benefit. So Tom, that was a good question in the Q&A and in the chat box, and that's something that would have to be contemplated for high net worth individuals. Definitely something beyond the scope here, something that we could answer for our clients or potential clients, and we'll talk a little bit about how to contact us to discuss those matters later on. All right. So the next slide is selling the operating company and the real estate at the same time. Just a general note, again, if you're a physician and you're selling your practice, say, and the building that you have the practice in, say for $5 million, you're going to try to want to minimize the allocation to the business and more to the real estate. And then maybe you could do a like kind exchange to do the further gain. Maybe you could get taxed at lower rates doing that. But the key is, if you're selling both, to look at it on a combined basis and sell and allocate the purchase price between the business and the real estate, and then the assets within both, in a way that will minimize taxes and give you the maximum ability to defer the tax. So that slide just points that out. We go on to the next slide. Okay, so we just alluded to this a little bit. In real estate investing, you could have very large losses in the earlier years generated by your investment. And that's because of depreciation. Just gave away a little bit the insight on that. So when you buy real estate, as Tom alluded to, you do a cost segregation study. So on that $1 million building, you probably could allocate $3,000-4,000 to furniture, fixtures, and equipment for the ovens, the stoves, things of that nature. And that could be immediately deducted in the first couple of years. That's going to generate a lot of depreciation deductions in the earlier years. So what may happen, as the box on the left says, that you may have positive cash flow immediately and have no taxation on that cash flow. you may receive distributions without paying taxes. And on top of that, you may get distributions and actually have tax losses and write-offs from that investment as a bonus, so to speak. The rules on if you could take the losses is a little complicated. We'll talk about that in a minute. But really, real estate's a nice way to defer tax. And then when you ultimately sell, pay the gain at capital gain rates versus ordinary rates. So you get to defer and convert. Defer to the future to pay the tax and convert from ordinary to capital. So it's real estate has always been a good tax-friendly way of investing. Tom, I don't know if there's any questions in the chat or the Q&A. I don't know if you have anything you wanted to point out or drill down on.
No questions yet, but I think when we get to the, maybe we can discuss the limits on what can be deducted
Sure.
on on a personal return and so on.
Okay,
Which
so we'll
is-
go to
Yeah.
the next slide then. Thank you, Tom. So owners may be able to take losses even if they have distributions. Here's the key though. There's a lot of rules to meet. And this is where you really need, and I don't want to keep on harping on it, an accounting firm and an accountant or accountants that know the tax rules relating to real estate. And I'll explain why right now. First off, rental losses. So what do I mean by rental losses? You invest $1 million into a rental LLC. Your K1 will be giving, a K1 gets issued to you for your proportionate share of the taxable income or loss. That loss, say, is $100,000. You could have got 70,000 in distributions and a K1 with a loss of $100,000. So you got cash that you don't have to pay on taxes right away, and you may get ability to take some losses. So you get that K1 and you say, oh, fantastic, I could take the loss. Not really. You have to check the rules and meet certain hurdles to take that loss. So the easiest way to take that rental loss is rental losses can first be used to offset other rental passive income. So initially, all real estate investors have this, put a hat on them that they considered passive. So if you have passive income, you could offset the losses right away. If that doesn't work for you, or if there's losses left over, then you have to try to convert your passive activity to non-passive, active. To be active, you have to be both A and B. A means the investment has to meet one of the 7 IRS regulations, which are quite complicated. It based on time, how much time you put in an activity, but you have to meet that passive loss rules, one of the 7, to be active. And then B is you must be a real estate professional. A real estate professional means you have to spend more than 750 hours a year in real estate and more than half of your professional working time. 750 hours could be managing your property you own, looking at property, traveling to see property. This webinar is hours towards real estate. You have to document these hours on a contemporaneous basis. I would use Outlook. Everybody uses it anyway. And make sure you go over the hour threshold. What's really nice is if you're married, it's one of the taxpayers. Okay. And if you are a doctor and you're running a practice, you're never going to meet the real estate professional rules. But maybe your wife, and I know a husband, I don't want to stereotype, okay, your spouse has more time on their hands. They're with the kids are at school. They could put in more than half their professional time in real estate because they don't work. Now they work. That's going to be easy, more than half. And all they have to do is work 750 hours a year. That's about 13 hours or 14 hours a week. And then they become the real estate professional. And with that, then the losses will be allowed to be offset against their other income. And that gets done a lot and can be done a lot. And we advise on that a lot. And again, you got to keep track of a calendar on a contemporaneous basis to do this. And I've had many audits where one spouse makes a lot of money and the other spouse manages the real estate, which releases the losses and can take the losses. I've probably been through 4 or 5 audits that we won, as long as one of the spouse is freed up to meet these rules. Tom, questions,
So, Andrew,
comments?
if let's say, both spouses are working and I just in these particular year or next year, I know I'm not going to meet this real estate professional rule, but I have losses. What do I do with those losses? What happens to them?
So the losses get carried forward. They're not lost. And they're used in a year where you have passive income or when you sell the property. So the gain that's generated in the year of sale could be offset by your PALs. That's passive activity loss carry forwards. Okay, PAL. So yes, you don't lose it. You should keep track of it. But obviously, I'd rather use it today and save money
Right.
today than when I go to sell the property 7 years from now.
Hey guys, can I
So I
chime
can
in
have a-
with a question? And I
Mike.
love the pulse because I've talked about the pulse versus pigs for a long time. So just to confirm, when you sell, let's just say folks don't use 1031 exchange, they just sell. They
Mhm.
generate a passive gain, which is called a passive investment gain. It's a pig.
Yes.
And they can they can deploy that money. If they don't do 1031 exchange, they just deploy it on a deal that runs a cost seg and generates significant depreciation losses. Then they get a passive allocation loss, and it works very similar to an exchange. They just offset the gains with losses and essentially move forward the same way as if they did 1031 exchange. The reason I mentioned this is another technique because 1031 exchange has strict timelines and there are rules, and if you one day late, you might blow up an exchange, and then you may
Yeah.
wind up, what do I do now? And
So
then
the
you
best,
go that
Mike, the
path,
best
pigs
year,
versus losses, pulse.
yeah, the best year to buy real estate or invest in real estate is the year you're selling real estate.
Yes, same year. Yeah. It has
Yeah.
to be in the same year. That's the only way this concept really works. Is got to
Yeah,
be.
I mean, I have a client who has 160 entities, mostly all real estate. They have not paid taxes, and they have substantial, 2 brothers that have substantial net worth around $100 million each. They have not paid income tax in 16 years because they just buy a few properties a year, and those properties generate enough depreciation and losses to offset any income they may have from mature deals, any sales and things of that nature. So if done right, these tax rules are extremely powerful. But you got to you got to know what you're doing to take advantage of it.
I wanted to bring
And
up,
it just alludes back to the point of planning ahead a few years in advance of your sale event and planning the purchase and the sale and working with very competent CPAs to make sure you're following the rules by the book. And it's not
Mhm.
just the compliance, but it's really forward planning. This is what we're alluding to. The
Yes,
forward plan has to be there because compliance, you're dealing with in the rear, and if you didn't make the timely moves, now you're dealing with the compliance that you have to pay taxes. And then
You
the other
can't.
question I had, you
Yeah.
ever see people they sell well they live in a high local state tax like New York or California, and then they play the game, they defer, then they move to Florida or they move to Arizona or they move to Nevada if you're in
Yeah.
California, and then they at some point do pay tax, but they pay it when they're a different resident.
Yeah. So we'll talk about moving to a tax-friendly state towards the end in a couple of minutes. But if you have a gain in a state that you defer and you move into a state that's tax-friendly or has no state income tax, technically you're deferring and you're supposed to pick it up in the year of sale anyway. It's supposed to follow you. That's the technical answer. What happens in practice is a different story, but
But
yeah,
not the
technically.
entire gain, correct, Andrew? Only the deferred portion
Only the deferred portion. Yeah.
Well, it's like a trail from New York, and like a tentacle, it's
Yeah,
still
and we'll
there.
talk. We got some good ideas on people moving to states like Florida, where I'm sitting in. Okay, by coincidence. So we have some good techniques. We're going to talk about that in a minute.
I just wanted to mention
yes.
the handout that you guys are, you also have provided us a handout, so I will email the handout out after this meeting. I just wanted to mention that, and that covers the IRS rules, right?
Yes, that covers the real estate professional rules and the 1 of 7 passive activity loss rules. Yes, those are great to have. Too technical to go into with a group in this short period of time, but yeah, it'd be great if they hand it out, and then we could be available to talk about that. And Mike said something. I always say you can't change the past. You can only change the present and the future. So planning ahead of time is key. The worst client is a client that comes to us, me in February, and says, I did this in June of last year. Well, it's hard for me to help you. But if
Yeah.
before June, if you came to me in January, I could definitely help you. We could definitely help you. So yeah, that's a great point, Mike. All right, so we go to the next slide.
Sorry, I went backwards. Okay.
No problem. There we go. Yeah. So taxation of sale of real estate, mostly taxed at capital gains, because you're really going to pay the hefty tax when you go to sell, and that's going to be at the capital gain rates. You can do a like kind exchange. There's also something that's not even on the slides that's expiring at the end of next year. That's opportunity zones, opportunity zone rules. We didn't bring it up. Maybe if a new president gets elected, that created the first, he was the, let's just say Trump created the opportunity zone laws. If he gets reelected, he might extend them. They're due to expire in 25. So that's a whole other area where you could defer or eliminate tax also is the opportunity zones. Being a real estate professional will also has 2 other benefits, which are really unbelievable. If you're a real estate professional, when you go to sell, you will not be subject to the Obamacare healthcare surcharge tax of 3.8%. So everybody says, yeah, the capital gain rate's at 20%. But if it's a passive investment, it's not 20%, it's 23.8%. Unless you're a real estate professional. Then it's really truly 20%. Also, if your real estate activity starts to mature and starts to generate real estate taxable income, if you're passive, you're paying taxes at the ordinary rates plus 3.8% on the Medicare surcharge tax. If you're a real estate professional, you don't pay the 3.8% surcharge. We got a client 8-9 years ago, very successful real estate operator, who literally was paying $40,000 to $50,000 a year on the 3.8% real estate. I mean the 3.8% Obamacare tax surcharge, because his old accountant had him as passive. He was a real estate operator. We changed him to real estate professional. It saved him $38,000 a year going forward. We amended 3 years worth of returns, and we got him back all that money. So it's this is something C and D that people forget, and could be very costly when you go to sell. You got a $10 million gain at 3.8%, that could add up fast. Okay, that's $380,000 on a $10 million gain that if you're a real estate professional, you don't have to pay. So
quick question.
yes,
This is a strategy question. Most folks who are professional who own the businesses, either doctors or dentists or other professionals. While they're professionals, they're operating in their field, they can't become real estate professional because they already have a primary trade. But their spouse,
they might have a spouse. They might have a spouse that could.
Yeah. So, but the other, just to bring it
Yeah.
up, real estate professional status is every year. Just wanted to make sure you clarify that.
Yes.
Because
Yes.
it's every year, once folks sell their business and then they retire, they can turn into the real estate trade while they're playing golf and enjoying their retirement. They can also clock the 750 hours and turn suddenly real estate professional and
Yes.
benefit in the retirement from being a real estate professional, not just at a time when they are selling their business. Just
That's
it
right.
will require some thought and planning, of course. But I just wanted
Yes.
to make sure that you confirm this real estate professional is a designation that has to be checked every year. It's not a permanent. It's a
Yes.
every year verify yes or no, move on.
And keep a calendar on a contemporaneous basis to substantiate that just in case you get audited. All right, Tom, any comments, questions here?
No, I think we're, we
Okay.
might want to check in on the time. Are we on schedule?
I guess we good,
Yeah, I think
Diana?
you're
Yeah,
doing great.
we're
We
fine.
need to wrap up.
Okay.
For questions.
Let's
So-
get through the slides and then I'll pull up any questions
Okay.
from there.
So real estate in conclusion can produce income that could be greatly, partly deferred or converted to capital gains, and all the other benefits like kind exchanges and so forth, cost segregation studies and depreciation, drop-in swaps. Tom brought up that term, which is dropping into a tick and then doing an exchange. So there's a lot of things with real estate that you could take advantage of. And again, you just need a competent CPA who knows his real estate tax rules. So the next slide is about self-directed IRAs. Over the years, a lot of people have invested using self-directed IRAs. You can use self-directed IRA money and invest in real estate. It's a little of a choppier water, let's say, okay? Because if that real estate has a mortgage, a UBIT tax may kick in at high as 37%. It generally doesn't get taxed until the sale occurs. That's when the sale occurs and the IRA investors like, I thought I don't pay taxes, it's an IRA. That is not the case. If you're investing in real estate with a mortgage, then a fair amount of the gain will be subject to this UBIT tax, UBIT. Okay, and you got to watch out for that. If you invest in a LLC or fund that produces interest and dividends, a fund that gives out loans, things of that nature, interest and dividend income is not subject to the UBIT tax, IBIT tax. So therefore, that if you're investing with IRAs, you may want to focus on those type of investments and portfolios within those investments, because interest and dividends will not be subject to the scrutiny. And it's not only the tax, it's scrutiny. The IRS audits more self-directed IRAs that invest in real estate. There's also prohibited transactions, and you may break those prohibited transactions when you invest in real estate, which means your entire IRA could be subject to tax. So number two is a much easier and investment-friendly way of investing self-directed IRA money. Mike, Tom?
Yeah, I have a quick comment. So just a few
Mhm.
things. So we've talked about the avoidance of UBIT quite a bit. And we've talked about some of our funds like Tempo Advantage Fund and Tempo Income Fund, because a lot of what they do, they invest in debt instruments, doing exactly what you said, investing in things that generate interest income, and those things are not subject to UBIT. So the
Yes.
most beautiful thing for self-directed IRA is not to invest in an equity of a deal with leverage, but to invest in a fund or a deal that where you're a lender, you're loaning money out. So
Yes.
100% agree with that point, and that's what we've actually put together for our funds that are IRA friendly, is to avoid the risk of the UBIT. So the point is very well taken. Appreciate you bringing it up.
Yeah, and I had cycles of investors getting into real estate 10 years ago, and they're starting to sell, and the IRA investors are seeing that this tax kicks in when it's a real estate leverage deal.
I just want to add, the Tempo Advantage Fund was well thought out for this because we also include that potential of doing the Roth conversion. I don't know if we're going to talk on that right now, but there's a lot of different advantages that fund has thought through. And also the Class D is the side of Tempo Income Fund that would be not subject to UBIT, but that is now fully subscribed. So just want to put that out there.
Okay. So
Yeah,
we go to the,
we continue
I'm
to
sorry.
think, sorry, and I have to wrap up. I have to actually run out to pick up my daughter from school. But to make long story short, Yeah, reach out. Ultimately, all investment decisions require a CPA, like Andrew or Tom, to give you input before you actually write the check, whether you're writing a check from cash or you're writing a check from a self-directed IRA. Always having a conversation with a competent CPA before you write the check will be very, very helpful to avoid that risk of UBIT or other just bad tax planning in general.
Absolutely. Thank you, Mike. So there's been a big craze, I've been part of it, of moving from the north to the south to tax-friendly, sunny areas like Florida, Texas, Alabama, Nevada, and so on that have no income tax. Okay. There is always a little strings attached though that you got to be aware of. The taxation of real estate occurs based on where the real estate is located, not where you live. So if you have real estate in New York and you live in Florida, you're still going to pay taxes on any taxable income generated from that real estate in New York. If you move into those tax-friendly states, you may want to look for deals where the real estate is in Florida, Nevada, Texas, because you're going to have real estate that won't be subject to state income tax. The other thing, interest, dividends, capital gains are not subject to state tax based on where the investment is, but where you live. So a fund that generates interest and dividends is really good for a Floridian investor, resident, because those interest and dividends will not be subject to tax, just like your bank accounts will not be subject to state tax, I should say. So this is really good to know, especially with this trend. Sean Hannity just announced he's getting off of Long Island. Billy Joel just announced he's getting off of Long Island. They're all coming to Florida, and there's got to be a reason. The guy who started Amazon just sold $1 billion worth of stock. Happened to be when he sold, he was a Florida resident, not in the state of Washington, because there was a 6% capital gain tax in the state of Washington. So he saved that by moving to Florida and selling his $1 billion worth of Amazon stock. So a lot here. We could talk about this for a long period of time. So let's move on to the last slide. This is our contact information. We will be happy, no fee, to have a conversation with you, a phone call, a Zoom, a Teams meeting, to see what your personal situation is and see if we can help you. Some people might not work. We'll let you know that. We want to work with people that we can help. And so we'll have a free consultation to really see if we're a good fit and if we could help you. That's our email addresses, phone numbers. You can email us. We'll give you phone numbers. But we're here for you. Tom, any thoughts? Last couple slides.
I see a question in here. I'm not sure if Mike and Deanna can see the Q&A, but they're asking what tempo fund may be better for after-tax accounts to avoid higher income tax and get lower dividends or long-term gains?
The best answer to the question would be to schedule time to chat. It'll take a long time, so it depends on the circumstances. So it might require a little planning. We have funds and we have syndications from time to time. So depending on the individual circumstances, for some folks, one-off deal with depreciation benefits may be phenomenal. For some other folks, they may be perfectly happy with an income-focused fund. And I want to point this out. Tax efficiency and taxation are incredibly important. But what is more important is actually prudent investment decisions. So investing just for tax benefits is not necessarily always the right strategy. So it's a combination of both good investments and some tax planning. So I'll just leave it at that. More than happy to chat with folks offline. And for this type of conversation, this type of questions, it's always great to bring your CPA into conversation and just have a quick conversation before you write a check.
Yep. Great planning is so important.
So I have a whole list of questions that were submitted before the chat, but I wanted to see if there's if there's anyone who has questions that would ask live, that were not submitted before, now's your time to either raise your hand, I'll let you speak, or you can type it in the chat. We don't need to know if you are trying to keep your anonymity. You can do that as well. So,
Yeah, I apologize. I have to run to pick up my daughter from school. So
Okay.
thank you, Andrew. Thank you, Tom. Thank
Have
you,
a good
Deanna.
weekend.
Thank you, everyone on this
Have a
call.
great weekend, Mike.
Continue the
Thank you.
Thanks
discussion.
for having us.
I just have to leave before my daughter starts saying, "Daddy, where are you?" Thank you.
And then you start getting a lot of calls and texts.
Yeah, exactly. I'm already
You know
getting.
how you feel.
All right. So, yeah, we're open. If somebody wants to jump on the Zoom here and ask some questions, we are more than happy to address anything.
let me just read one out loud real quick.
Sure.
So is there any advantage on selling part of the business or the practice in 2024 and then part in 2025?
Without knowing your personal circumstances, I think we could only say that in 24, we're pretty confident that the capital gain rates will be 20%. Depending on the presidential election, don't know what the 25 rates will be. So if you're contemplating a sale that's going to be eligible for capital gain rates, which hopefully it would be, then the more you sell in 24 rather than 25, the more you're going to lock in the lower capital gain rates. It's hard to speculate what 25 is going to be, but I think it's safe to say that 24 rates will be equal to or lower than 25 for sure.
Another question is, are long-term capital gains considered passive income?
The capital gain is determined, and the passive label of a capital gain or loss is determined at the activity level. It could be passive or non-passive capital gains. So if the underlying asset that you're selling has always been passive, in the year of the sale it's passive, it will be a passive capital gain. If the underlying asset that you're investing has been non-passive or active, especially in the year of sale, that capital gain would be non-passive. So it ultimately goes down to figuring out what you're selling and when you're selling it.
Someone asked, I have several real estate LLCs. Can I be a passive investor in one and an active in another?
Yes, absolutely.
Yes.
A lot of the tests are done on an activity by activity basis.
And you can group them to bring them, to cover you for all of them, as a real estate professional. But if you don't, then yes, you could be active and passive in each.
Correct.
And so how do passive investors benefit from investing in syndications?
If they have, so repeat the question. Deanna, can you repeat the question?
Okay, so how do passive investors
Mhm.
benefit from investing in syndications?
Okay, so
Are
if the passive
the-
investor has passive income, those syndications will generate passive loss to offset that immediately.
Someone
That's-
also, they followed up with, are the benefits mostly down the road when the deal sells?
It depends on the individual situation, but if this person has 5 other investments that are passive, that are mature, and that they're generating passive income, they can immediately use those passive losses to offset it. So it really has to be determined on a individual by individual basis. There is ways of using the losses today, or they may be carried forward, but without looking at a specific situation, I think that's all we could say, right, Tom? Is there anything else you could think of?
Yeah, it's a lot of it's very individual.
Well, I think this was already answered, but are there any advantages to holding a few pieces of real estate to retain real estate professional status? I think the
Again,
answer would be
Just-
Just ownership? It has to be
yeah,
more
they're
than
they're
just
trying
ownership.
to if there's benefits to I guess it's a personal situation again because um they're trying to hold on to this real estate so that they can retain their status as a real estate professional, but
Yeah,
um
the just holding real estate is not gonna put the real estate professional hat on you. You have to specifically meet the 2 rules and they're just black and white. 750 hours or more than half of your professional time to be a real estate professional. And then each activity, you have to meet the 1 of 7 rules to make it non-passive. So just owning real estate is not going to do the trick. It's meeting the
Yeah.
rules that will do the trick.
Owning it will just make you an investor, not a real estate professional.
that's good clarification. Um, I will definitely send out this handout you guys gave me with your contact information to everyone. So I will follow up after this and give everyone those rules so that they know exactly what they are needing. And I think it's awesome that you guys are offering that free consultation. So they'll have your contact information and can reach out if they wanted to ask their personal situation questions.
Sure.
We have one last question and then we'll wrap it up from there. What if someone moves to tax-friendly state, then sells the primary residence in, say, California? Is that going to save is that going to save state tax and then do the 1031 is what they wrote?
Well, first off, you have a $500,000 exemption for gains. So part of your gain up to 500,000 may be exempt from federal and state tax to begin with. That's the first thing that you should take advantage of. Then moving to a tax-friendly state, they move from California to Nevada. It's the closest state to California, has no state income tax. You get taxed by where the real estate is located. So if you gain is 700,000, you have a $500,000 exemption, that $200,000 is going to be subject to gain at the federal level and at the state of California's level, because that's where the real estate's located. It doesn't go by where you're located. It goes by where the real estate is. And if it's your residence, it's not going to qualify for like-kind exchange. If it's a rental property, then you could do a like-kind exchange if you meet the criteria.
Thank you for clarifying that. Well, I really appreciate your time, both Andrew and Tom. Thank you so much for all of the answers you've given on this webinar. It's really great to have you as our resource. And thank you everyone who attended. This will be uploaded to YouTube, and so you can review it if you'd like, but definitely reach out. I'll be in touch and we'll make sure that any of your further questions will be addressed. So Andrew, Tom, thank you, and I hope you have a great weekend, everyone.
Thank you very
Thank you
much.
for having us.
Yes.
All right,
Have a
take
great
care.
day. Bye-bye.
Bye-bye.
Bye.